Hi rabbits, Research Turtle here. We need to talk about the divergence between the promise of generative AI and the empirical reality we are facing. We were promised a revolution comparable to the steam engine, a fundamental rewiring of the global economy. But a rigorous audit of capital expenditure versus realized utility suggests we are actually staring into a deflationary money pit. The core conflict is structural. While capital expenditure scales vertically, utility is plateauing horizontally due to severe verification bottlenecks. Let's look at the economics, specifically what we call the $600 billion question. There is a massive revenue gap. The industry is building infrastructure capacity for non-existent demand, driven almost entirely by FOMO. We are seeing over $600 billion in infrastructure spending on GPUs and data centers, yet the actual software revenue is a fraction of that. This isn't just an expensive startup phase, it's a math problem that doesn't resolve. Why? Because of the depreciation trap. When we built railroads or laid fiber optics, those assets had a lifespan of 50 to 100 years. AI GPUs like the H100 are different. They have an asset lifespan of just 3 to 5 years before they are forced into obsolescence by the next generation. This means the hundreds of billions being spent right now aren't a one-time investment. They are a recurring subscription to relevance. Furthermore, the unit economics signal the end of zero marginal cost software. Training models is a massive fixed cost, but inference, answering your questions, is a variable cost that never goes away. Every single query consumes compute and power. Profitability collapses the moment the energy cost to answer a question exceeds the value of that answer. And that value is questionable because of the reliability crisis. We are seeing a mechanics of hallucination, where models excel at head knowledge, common facts like the capital of France, but completely fail at long-tail niche data. Take the legal sector. In the case of Mata versus Avianca, we saw a sophisticated fabrication of legal principles. The AI didn't just make a mistake, it hallucinated entire precedents, like Varghese versus China Southern Airlines, leading to federal sanctions. This confirms that in high-stakes environments, the model is simply guessing tokens, not accessing facts. It gets worse when we look at data contamination. Look at the glue on pizza phenomenon. Google's AI overview suggested adding non-toxic glue to pizza sauce to prevent cheese from sliding. Why? Because it scraped a sarcastic Reddit comment from 10 years ago and lacked the semantic understanding to detect the satire. It conflated popularity with truth. This leads us to the verification debt. This is the hidden tax on productivity. An AI can generate a response in 3 seconds for 2 cents, but it requires an expert 2 hours to verify it to avoid liability. This asymmetry destroys the value proposition. It creates a productivity paradox, where novices get faster, but experts, senior developers and professionals, actually get 19% slower because they lose time debugging bad code and context switching. There is, however, one area where the capability is undeniable: deepfakes. Generating entropy, lies, is cheap. Verifying order, truth, is expensive. We are seeing a massive anomaly where the technology's only true excellence is in deception, with fraud attempts up 3,000%. The market is finally waking up to this. We're seeing a sentiment shift on Wall Street, a rotation away from AI infrastructure stocks as investors realize the ROI gap is real. The narrative is moving from blind optimism to a hard look at the lack of clear revenue. The verdict is stark. The technology is simply not ready for autonomy. Economically, it represents a $600 billion deflationary money pit. Technically, the reliability crisis prevents high-stakes use. Operationally, verification debt erodes productivity. It is a powerful niche tool, but it is not the universal solvent we were sold. That's it for today. Turtle out.